Hey there guys, welcome back, and with the introduction out of the way, let's just look at what is a derivative, and then we'll move on to look at the different types of derivative, and where the derivatives are traded, and how much is the value for derivative in the financial markets. So what is a derivative? It's kind of a financial instrument which derives its value from some other asset. For example, oil futures derives its value from the price of oil which is currently trading in the market, or maybe some stock options derive its value from the underlying, which is the value of the stock itself which is traded on the market. So this is kind of this is what the derivative is. It just derives its value from some other asset. All right, so it could be anything. You can structure it in any way, and like for example, a stock option derives its value from the price of a stock, or maybe in the same way derivatives are dependent on any variable or an asset. Alright, so there are credit derivatives, weather derivatives, derivatives based on a farm's produce, like a farmer's produce. Yes, typically derivatives were used by the farmers to hedge their produce, so that in case of any unforeseen contingency were to happen, so that they are safe, and that's the whole point of using derivatives. So to hedge your produce, so to hedge against any unforeseen circumstances which might come in the future. Obviously, over the period of years, people have started speculating in derivatives, and that's how the whole market is built up now. So there's speculators, there's arbitragers, and then there is hedgers. So that's kind of the community of people who typically trade derivatives. Alright, so with this, let's go to the different types of derivatives. Yeah, so the different types of derivatives are forwards, futures, options, swaps, and warrants. So we will go these in detail, but just to give you an overview here, so forwards are relatively simple derivative contracts, which is kind of an agreement to buy or sell an asset at a certain future time for a certain price. So it can be contrasted with a spot contract, which is kind of an agreement to buy or sell an asset today. So spot and forwards. Spot is today and forward is in future. Now, an interesting thing about forwards is they're not traded on the markets, and they are traded over the counter, which is again we'll be seeing when we'll be looking at the types of markets. So yes, so forward contracts is a very basic and simple derivative agreement which involves buying or selling an asset at a certain point in future at a certain price. The second thing which I want to talk here is the futures contract. Futures contract is nothing but the forward contracts, but then they are traded on the market. So you can typically buy a future contract on the market, whereas the forward contracts are typically over the counter and they have to be structured. They are not readily available, or they're not readily traded on the markets. Now again, the options here, we'll be looking at the options, what are the kind of options in detail, but then just to give you an overview here, they give the holder the right to buy or sell at a certain point at a certain price, so certain point in future, I mean. So again, there are two kinds of options, which is kind of a call option and put option. Call option gives the holder the right to buy the underlying asset, while the put option gives the holder the right to sell the asset. Now one thing to note is options are traded on both the exchanges, like both the markets, like on the over the counter and traded over the exchanges. Alright, so this was options. We'll obviously look at in detail when I'll be explaining you in the next set of videos. So now let's look at what is swap. Swap is basically you're interchanging your derivative with someone else's derivative for a certain benefit to both the parties. So swaps is again we have seen like I've told you that it is basically an exchange of different instruments at a future point, and the idea behind the swap is to exchange the cash flows from different kind of instruments at a future date. Alright, so swap is kind of an over-the-counter agreement between two parties, and to exchange cash flows in the future. Now the agreement defines the date or the time of when the cash flows are to be paid and the way in which they are to be calculated. Now usually the calculation of the cash flows involves the future value of an interest rate or an exchange rate, or other market variables. So a forward contract can also be viewed as a simple example of a swap. For example, let's say it is May 1st 2020 and the company enters into a simple forward contract to buy 100 ounces of gold for let's say 1100 per ounce. In 1 year the company can go ahead and sell the gold or gold in 1 year as soon as it is received. So in a way, what I'm trying to say is the forward contract is therefore equivalent to a swap, where the company has agreed that on May 2020 it will pay something kind of some value to receive 100 ounces of gold. However, swaps can be swaps are typically based on interest rates or fixed for fixed currency. So the most popular swaps are plain vanilla interest rate swaps and fixed for fixed currency swap. Now the last thing here is warrant. So warrants is typically they are options issued by a financial institution or a non-financial corporation. So now warrants are typically grouped with employee stock options and convertibles. Typically to exercise the warrant, the holder of the warrants would have to contact the financial institution. Now a common use of warrants is by the corporations who typically issue bonds. So what happens is the corporation issues call warrants, like the ability to call in the future on its own stock, and then attaches them to the bond issue, so to make it interesting or lucrative for investors. So that gives an investor a power to call a bond and convert it into stock in some future time, in case the investor wants to do it. So yes, so this is again kind of a convertible thing, but again the interest on this kind of security would typically be lower than a non-convertible bond. So that's why it is also beneficial for the corporation who is issuing it. Again, employee stock options, as I said, are called options issued to the employees by their company or corporations to motivate them to act in the best interests of the company. So typically is a startup or it could be a major corporation, but then typically smaller companies do give their employees stock options so that they stick to the company or they perform better, so that in case the company were to get listed in the future, they would derive benefit out of those options, like the stock options. So warrants, employee stock options, and convertible bonds are some kind of derivatives which are looked at in unison. So you will hear warrants and then ESOPs and then convertible options. Alright guys, so with this we'll move on to the next slide and let's see the kind of the value of derivatives which is traded in recent times. So the overall value of derivatives, so a low end estimate would be $544 trillion is the kind of derivative industry, which is kind of a low end estimate. A high end estimate would be like 1.2 quadrillion. I don't even remember how many zeros are there in that, but yes, it's kind of a big money. It's not tangible. It's something which is just up in the air. It's just that if the tangible assets were to get blown, this whole thing would just crumble down. However, no one really knows what the exact size of the market is as of today. So it is between 544 trillion to 1.2 quadrillion. Now let's look at the markets for derivative. I've already told you exchange traded and over the counter. Now over the counter are where the corporations get in touch with the banks and then they ask them to structure products according to their needs. It's something which is tailored to their needs, and it's not exchange traded. It's like it's not traded on the market. So for example, you cannot just log into your broker's portal and buy buy a derivative. It's not that. It's just that those are the kind of derivatives which are exchange traded. So exchange traded are the ones which are traded on the exchange. Like you can log into your platform, your broker's platform, and buy them and sell them during the course of the day, which are just there, and there is liquidity around them. But then over the counter derivatives are specifically tailored to the customer's needs, and typically big corporations and the companies involved in hedging are the ones who are parties to these kind of transaction, and there is little demand of them, so there's less liquidity around them. So you will have to find someone who who has got the similar needs in case you want to sell that kind of derivative which you possess. So with this, we have just covered a little bit of the introduction, and yeah, so in the next set of videos, let's look at the derivatives, the different derivatives which we discussed in detail, and the parties involved therein. Alright, so see you in the next video, and bye for now.